Welcome to The Wing, the emotional and financial health check you never knew you needed.
Hello, ladies. Welcome to another episode of The Wing. Today, we are very excited to host another guest, Jessie Chen. Hi, Jessie.
Hi, Katie.
Welcome. We are welcoming Jessie Chen. She is a partner and senior mortgage broker at Loan Market, and she's also an elite performer, which means she's in the top 5% of the entire Loan Market network. Jessie knows her stuff and has personally written some loans for Jake and I, and is here to share some knowledge, some specific questions that I'll be asking Jessie around first home buyer benefits and a few other details that might just help you ladies get your foot in the property market a little earlier than maybe you would have expected. So we'll jump straight into the content. So Jessie and I have been preparing to make sure that we get the most out of this session with Jessie's time. We're going to dive straight in and talk about the first home buyer benefits. And Jessie, I might have many questions as we're chatting because I'll be obviously thinking about our listeners and thinking about what they might wonder in the meantime.
Thank you, Katie, for having me today. I know the idea of taking out a mortgage or committing to such a major purchase can feel really, really overwhelming, especially when it's not something that we're being told in school. However, hope my session today can help you feel a bit more confident when it comes to making the financial decisions, especially the decision to buy your first home. Here's the thing. There's a lot of people don't realize that there are actually some great benefits available that are designed to help you taking out the first step into the market with a little bit more support behind you. Here's some example of the government benefits that you may be eligible for as a first home buyer. So for example, let's say stamp duty concession. You might heard about the stamp duty before. So stamp duty is a tax levied by state government on a certain purchase, including by a home, by a land, or investment properties. As a first home buyer, you may have opportunity to pay a discounted amount or pay nothing at all for the stamp duty. So for example, ACT, buying $500,000 home, stamp duty is close to $9,000. But buy a $1 million home, stamp duty is more than $34,000. If you're a first home buyer, you have opportunity to get in concession and not paying that $34,000 at all. So in New South Wales, the maximum purchase price allowed for the stamp duty concession is about $800,000. Eligibility tests are a bit different by states, so please make sure you're looking into this before the purchase or simply give us a call to confirm.
Perfect. So, Jessie, as a bit of a summary there, so basically the stamp duty concessions vary from state to state, and it is dependent on where we're looking to buy in the first instance, obviously providing that it is a first home, and checking that with you before you get too far down the road. Now, is this a step to learn about the stamp duty and the concessions available before someone would engage with a broker to discuss what they're eligible to borrow?
So it really depends on the state. Some of the state, your eligibility will be done by your conveyancer, your solicitors. And some of the state like ACT and New South Wales, you definitely do that yourself. So you need to do the eligibility test yourself to make sure you are eligible. We could give you some information, but it's your responsibility keeping all those supporting documents for at least 7 years, just in case the government coming back to you and asking for the evidence. So if you're not quite sure, we can help you to give you some idea to start with.
Perfect. So, and in, I think, most instances when we are looking to if we want to get into the property market, or we're looking whether it is to invest or into purchasing a principal place of residence, the first stop in a conversation like this would often be with a mortgage broker to make sure, obviously there's what access you've got to cash, what equity you might already have, what your actual journey looks like, but it's at the very early stages of this process that someone will be wanting to connect with a broker.
That is correct. So we actually have more benefits available as well. So for example, stamp duty deferral is another one available in ACT. This one is designed for the people has the income more than the stamp duty concession threshold. So your income might be too much to be qualified for the stamp duty concession. Then you should be able to get in a stamp duty deferral with ACT government. So this is another potential one you can be on. We also have a lot of states still have the first home owner grants. So ACT no longer having it, but the majority of the other states still having the first home owner grant to helping you to making the purchase. But of course, different state has a different grant available. So give you a couple of examples. Let's say New South Wales, they're still offering 10,000 first home owner grant for eligible first home buyers of buying the new home only, with a property value limit. Of course, Queensland, they're still having roughly about $15,000 of the first home owner grant available from 30th of June 2025, and for a property value maximum $750,000 of the purchase for the new home only again. So different state has a different one. Just make sure you're looking into that one as well and make sure you're not missing the benefit. Lastly, we have first home guarantee scheme or regional first home guarantee scheme, which allowed first home buyer to buy the property with only 5% of the deposit with all other purchase cost. So for example, in ACT, if you are eligible for first home guarantee scheme, you can buy $750,000 of the property if you have a $37,500 of the deposit, which is 5% plus all other purchase cost. Again, different state has a different purchase price, so please check before you're making the purchase. We have more and more to come. We have the help to buy will be coming up soon as well. So the scheme works by allowing the buyer with a deposit of 2% only and obtaining a loan with an equity contribution up to 40% from federal government. So basically, you and the government owning the properties together. We're still waiting for the federal government to confirm the finalizing this scheme with majority of the state.
Okay, that's amazing. In a traditional instance, if you are just going out to buy a property yourself under the first time buyers scheme, you're looking at needing a 5% deposit. But when this is passed, when the help to buy is passed by the federal government, then it will go down to, if you qualify for that scheme, then you would only need to have a 2% deposit.
That is correct. Minimum 2%.
Excellent. Now, in terms of these schemes, you mentioned some dates there in terms of when a certain scheme is effective from. Are these schemes updated every year? Is it sort of working on financial years? Are there any patterns in terms of the schemes being updated? And again, does that vary from state to state?
Yeah, so generally those benefits update every single financial year, including for the eligibility as well. So stamp duty concession generally is updated on 1st of July. So the income threshold, purchase price threshold would be updated. For the first home guarantee scheme, this year they haven't making any of the changes yet. But in December, we will know whether there's another new scheme replace this one or the government going to be continue running this one. So yes, it will be updated. It really depends on the government.
Perfect. And I guess a message there is that, I guess a lot of people are always looking for the right time to get into the market. But what we've kind of always learned, or I've learned a lot, in talking to different professionals in the space, is that the right time is when it's the right time for you individually. So irrespective of when these schemes are being changed or released, if you are in a position where you are ready to purchase, or at least think about the purchasing process, there's no point in holding up a conversation for some time down the road. If you are wanting to start your property investment or your property journey, it's better that you are speaking with professionals like Jessie to kickstart that whole process as soon as possible.
Yeah, that is right. And especially when you're thinking about buying, sometimes I working with my clients 6 months prior to making a purchase, or even 12 months before they're making a purchase, to helping them understanding where they're standing on, what they want to achieve, and what they want to do. So if you are thinking about getting into the market, just have a chat with us as soon as possible, so we can hold your hands all the way through until you're reaching your goal.
Absolutely. And it sort of echoes as well the conversations that we have at Dashdot as well, in terms of, obviously we are only dealing in investment properties in that space. So that's different to, the principal place of residence conversation that we're having, but it sort of all ties in that you can be thinking about going on this journey and maybe not be ready exactly right now, but by engaging with services to find out when you might be ready are going to give you all the information so that you're not stressed or missing out. You're not feeling like it has to happen tomorrow, and you've got time to prepare for what will be a big transaction and a big change for you.
That is exactly right.
Perfect. Did you want to go on to lender requirements?
Yeah, sure. A lot of people ask me what the lender going to be looking at, whether I'm going to be qualified for a loan. What a complex conversation, but it's actually really simple. What lender are looking at when you're applying a loan or getting a mortgage from the bank, they're only looking at three major things. They're looking at your credit check, they're looking at your deposit, they're looking at your borrowing capacities. If we can have those three big things taking off, the lender will be more than happy to give you the loan, subject to your final property to purchase, of course. So credit check, very simple. The lender do a credit check on you before they're looking into further to your applications. They want to make sure you have no credit default. Default means you're missing payment for something for a very, very long time, never paid it back, so they treat you as a credit default under your name. They're also looking at your companies. If you are director of the companies, doesn't mean that's a bad thing. You can absolutely have a company. You can run your own business. But if you have a company under your name, the company can hold liabilities, company can run in loss. So the lender just want to simply check what's the status of your company. And lastly, they're looking at your misconduct. So when I say misconduct, let's say you have a credit card, you have a personal loans, car loan. Have you ever missed the repayments in the past? So they can see you're missing payment from your credit check. Very often they were thinking if you're missing payment for the credit card or car loans, what happened in the future? You're missing the repayments for the home loans. So as long as all those ones are fully disclosed to the lender and you're never missing your repayments, your credit check should be fine.
Excellent. And Jessie, a question on the credit checks. So I know that can sometimes maybe be a bit of a scary phrase, being credit checked, but you mentioned a few things there, like a personal loan or a car loan or credit cards, or maybe even, credit card similar sort of programs like Zip Pay or Afterpay, that type of thing. If you have those, that it's not necessarily a negative thing or a detractor to have any of those, things that already have debt associated with them. It's a case of just making sure that every fee that is a part of one of those things are all paid and all up to date consistently for the lender to want to approve you for a loan.
That is exactly right. So the credit check, the only other thing is the credit card limit might impact the borrowing capacities a little bit. Later on, when I'm talking about the borrowing capacities, I might give you some example how those things going to be impacting your borrowing capacity as well. But if your borrowing capacity allows, you can still run in those credit card, having those credit card, just make sure that you're making the repayments on time.
Wonderful. Great advice. Moving on to deposit. So what we're actually looking at here in terms of a deposit.
So the lender also wants to see how much deposit you're having that you can put into the purchase and what's going to be the loan to value ratio as well. So for the purchase, except for the deposit you need to put into the purchase, you also need to factor into some other purchase costs, such as your legal fees, which is your solicitor conveyancer fees, council rates adjustments, building pest reports, and also sometimes the lender charge you upfront valuations fee. So let's say you have 5% of the deposit for the purchase under the first home guarantee scheme, and you also need to come up with additional maybe between $5,000 to $7,000 to cover for the other purchase cost. When you're borrowing the money from the bank, so let's say $1 million of the property, you try to borrow $900,000 from the lender working out the loan to value ratio by using how much money you borrow from the bank divided by your purchase price, working out this ratio. So loan to value ratio. In the example of $900,000 of the borrowing for a purchase $1 million, the loan to value ratio is 90%. Generally, when you're borrowing the money more than 80%, the lender will charge you additional insurance called lender mortgage insurance. This insurance protects lender, never protects you.
So that breakdown as well on the loan to value ratio, or if you are looking or reading into anything to do with property or lending it'll come up as a LVR and have that percentage next to it. So Jessie's just given us that breakdown there so that we can understand what that actually means. But yes, if you could go into some more detail on that lender mortgage insurance, Jessie, and why, if it is a benefit to the lender, then it's obviously a cost to the buyer.
Yeah.
What do we need to be aware of?
So when we try to borrow the money over 80%, the lender obviously thinking this loan has a little bit more risk. They need to seek in the insurance protecting themselves. So for example, let's say I borrowed $900,000 today to buy a property for $1 million over 80%. The lender will treat me as a high-risk customer. In 2 years later, I losing my job. I won't be able to making the repayments. Fingers crossed, never happen. So I can't making the repayments. I give in the key back to the lender and say, here's the key. You can sell my house. I won't be able to make the repayments anymore. And they will put my house on the market for a quick sale. If I didn't maintain my house really nice and they sell the property for $800,000, they will come into the insurance company and say, I lent Jessie for $900,000 buy this property, but now I only resell the property for $800,000. I'm making loss on this transaction for Jessie. So the insurance company will come in on board and cover that loss for the lender. So lender has no loss anymore. But for me, I lost my job, I lost my home. So there's no benefit to me, but lender is covered. So that's how the lender mortgage insurance is working. Lender mortgage insurance can cost you thousands of dollars or even more than $10,000, $20,000, depends on the loan size and depends on your LVR, loan to value ratio. Of course, we have first home guarantee scheme can help you to save LMI, lender mortgage insurance. Some special professional occupations can help you to save the LMI as well. So for example, if you are working in the medical industries as a professionals or working as a lawyer, accountants, you're possibly getting the lender mortgage insurance waiver, even you are not first home buyer. So again, make sure you come to have a chat with us and make sure you don't missing out the benefits when you are borrowing.
And I suppose their message as well, Jessie, is that if you have more of a deposit saved in the first instance, then you won't necessarily need to borrow as much, which reduces you as being a risky candidate for a loan. So if you can try and aim for an LVR that is under 80% or less, then that would make you completely avoid the loan mortgage insurance altogether.
That's 100% correct. Yes.
Okay, excellent. All right, that's very helpful, Jessie. Oh, and just another question on the LMI. At what stage of the process would a buyer be finding out about what that cost will be to them?
So once you finalize your purchase price and based on how much deposit you're having, and then it's very easy for us to working out how much the lender mortgage insurance is going to costing on you.
Wonderful. So again, this is why you have a mortgage broker, because they are able to identify these different costs that will potentially be incurred along the way and let you know exactly what your journey is going to look like before you're too far down the road, or maybe you're having a conversation with a bank directly one-on-one, and then that's the only visibility that you get is just into that one bank. Whereas when you're speaking with a mortgage broker, they're not only going to be talking to over 60 different lenders on your behalf, they're going to be able to get into the nitty-gritty with you and actually step through this part of the process and make sure that you are safe along the way, so that you're not overcommitting yourself, or you're not in a position right at this very moment to go down a path you maybe previously thought that you could. So it's that safety net of having somebody on your team that is going to manage that entire process for you.
That's right. That's awesome.
All right. Now, Jessie, can you talk to us about borrowing capacity? So income, liabilities, living expenses, and what we need to be aware of in that space.
No worries at all. So for the borrowing capacities, the lender are generally only focused on three things: income, liabilities, and the living expenses. Unfortunately, they don't care about how much cash on your hand. If you have $3 million cash on hand, it's not going to be impacting your borrowing capacities, because they're only looking at your income, liabilities, and living expenses, unless there's $3 million generate a lot of the interested income for you. So let's say, for example, as a single borrower, income of $65,000 has no liabilities, minimum living expenses, your borrowing capacity around $360,000 with a normal lender, based on today's interest rate. That's just a very simple example. If you have additional liabilities, We mentioned about the credit card at the very beginning for the misconduct section. And if you have additional liability, let's say additional $1,000 of the credit card limit, your home loan borrowing will be reducing roughly about $5,000. If you have $10,000 of the credit card, you're borrowing on the home loan, the loan amount will be reducing at about $50,000.
That's interesting. So you could kind of have, as much cash as you have, but the banks are really, or the lenders are really looking at your daily or your day-to-day habits and your track record. So if you're looking at things like income, is that secure and stable, and how long you have that income for? What are those liabilities, like credit cards, personal loans, children, I think fall into that category,
Yeah, that's right.
expenses and so on.
That's right. So simply just because the lender cannot control how you're spending your money, so you can have $1 million of the cash, but you're spending that travel the world for the next 2 years and you have nothing left over. If that's the situation, so how you can making the repayments become the major thing. If you're still having the income, you have your income is good enough to cover for the liabilities. In that situation, the lender will be fine with it. Even with the credit cards, let's say $1,000 of the credit card limit, the lender cannot control you not spending this credit card limit. If you fully draw on your credit card limit and every single month you need to now making the minimum repayments into the credit card, so that will become additional liabilities for you.
And in terms of a change in circumstances, Jessie, so okay, say you've gone down this road and maybe you're single at the time and you're going to purchase a property yourself or with a partner or whatever the setup may be, and you go through this process initially, and you might get all the way through to actually finding a property, and you settle on that property, and then you're in it, right? So you've got, you're making your payments, you're handling the expenses and anything else that comes across with that property. Now, if you have a change in circumstance, like say you've got a baby on the way, or you go through a breakup with the partner that you purchased a property with, or if you had a guarantor arrangement, like what in those sort of major events that might fundamentally change your circumstance, what do you actually do at that juncture? Is that a conversation with the broker? Is it like, where do you even begin?
Yeah, definitely. So if your situations actually start to changing before making the purchase or even after the purchase, it's always going to be a good idea for you to come back to us, have a chat with us, and we will let you know how does that going to be impact your borrowing or impact your existing loans. So for example, if you have additional baby, that obviously will increase in your cost of the daily expenses. In here, it will be impact your borrowing capacity.
So it's just a case of monitoring what your circumstances are and always making sure that you've got that contact with your broker so that you're able to navigate those changes coming up. And I suppose that probably leads into a quick question around refinancing. In what situation would somebody refinance? Is it prompted by the property owner? Is it prompted by the broker? Where does a refinance fit into the whole situation?
Yeah, no worries at all. So for the refinancing, simply is remortgage your property with another bank. Generally, the things trigger for the refinancing would be including your interest rates with your current bank. So for example, if your current bank offer really high interest rates based on today's market, didn't review for years, and you find out that another bank actually offer more competitive interest rates, that's the time for us to refinance to another lender. Sometimes the other purpose you may having for the refinancing, let's say your property value has been increased by $100,000. Now you feel like it's a time for me to do the renovation on my house, and I need to put out more equities available in my current property to do the renovations. That's another thing might trigger for the refinancing. Ideally, we want your current lender looking after you, and so you don't have to refinancing every 2 years. So as a mortgage broker, what I did a lot is I just go back to my clients and review their interest rates and make sure their current lender looking after them.
Perfect. So it's something that you as a broker will work on behalf of your clients for, to keep an eye out and make sure that they are getting access to the best possible interest rates as time goes on. And if there is anything that's flagged along the way, you're able to let them know about that, because obviously there's a lot, I think interest rates is probably one of the most said words or said topics in the news media. And that when that RBA announcement comes out, I think it's every 6 weeks now, it just puts the fear of everything into everybody because, are they going to go up? Are they going to go down? Are they going to stay the same? But really what's relevant is whatever's relevant in your own situation, whether that is you're about to buy, you've already purchased, or you've owned something for a number of years, then the interest rate conversation is something to have and bring, kind of localize it rather than catastrophizing it, and speak with your broker to make sure that, you've got the access to the best possible rate at the best possible time for whatever your situation might be.
That's right. Yeah.
All right, Jessie, I want to talk to you about a topic that keeps coming into my inbox, and I find it fascinating because it's also something that we talk about a lot at Dashdot, and we find a lot of our clients sort of operating in this space when it comes to property investing. But the topic is rent vesting. Basically, for my listeners who maybe you've heard of this or maybe you haven't, rent vesting is basically where you want to live in a good location or live in a specific location that might be close to work or facilities to support whatever lifestyle you're living at the time, but you may not have the funds available to actually purchase in that area. So you might rent in the epicenter of the state or territory you are, and then you might start to go on an investment journey and invest around in other areas to still build up a property portfolio, but not actually have, be limited by what can be higher costs as a result of living in, very busy sort of cosmopolitan style areas. So, Jessie, from your experience, do you have clients that are in the rent vesting space? And if so, can you tell us a little bit about your perspective on rent vesting and what you know and what we might need to be aware of?
So in ideal world, of course, rent vesting become more and more popular just because house price obviously become more and more expensive. People wants to live in a good location, close to work, close to shop in order to support a busy lifestyle, but they also kind of want a property that giving them a strong capital growth. The property giving them the strong capital growth would be the property has a land. So with a land attached to it rather than the unit or townhouse. Generally, the land have better or strong capital growth. I have some examples. So challenging for those ones actually is the land in the inner suburb actually is quite expensive and it's not affordable. Rent vesting options become more popular just because then you can live in the ideal world. So you can rent in the properties in the good locations, close to work, close to shop in order to support your lifestyle. But in the meantime, you can still invest in somewhere else, has a very strong capital growth. I have some clients living in Sydney. So Sydney market. So they're working and living in the city. So rental expenses actually is not too bad. Compare you buy a property spending $4 million in the apartment of Sydney. They bought a property 65 kilometers away from city in Sydney still. So the price is much more affordable. After a few years, the property they bought 65 kilometers from the city had very strong capital growth. So they made roughly about $400,000 on the property increasing. They resell the properties, they now have the cash, and they be able to invest our properties a little bit closer to the city. So that's the way they're doing their investment. In the ideal world, they're still living in good locations, but they also own our properties in the area that has a strong capital growth. Then another major benefit for the rent vesting is when you're purchasing an investment properties with a strong capital growth, or the interest expenses on the loans for that investment actually is a tax deduct. So it's basically like you receiving the rent for that property with a strong capital growth, and the interest that you're spending on the mortgage for this investment loan actually give you the tax benefit as well. Essentially, a lot of the financial planners are talking about home loan. You want to pay off that loan as quickly as you can. Essentially, you hopefully in the future, or hopefully ideal world, you have no home loan left over, but investment loans is the good loans because they're the one can bring you tax benefit and get you claiming the tax back from ATO. That's also another benefit that for the rent vesting is you have no home loans, but you have those investment loans create a tax benefit for you. In the meantime, give you a property with a strong capital growth.
Great point, Jessie. And that's something that definitely needs to be thought about when it comes to property investing and what your personal tax situation actually looks like. And you mentioned there, Jessie, as well, that financial planners are often the ones that are having these conversations with their clients about, or even accountants, what you should be looking for, or what's going to, depending what your goals are and what you want, your creation of wealth and ultimate financial freedom to look like. What are the things that you can do in the meantime in terms of the strategy that you're purchasing in to benefit and tick off those goals sooner? And one of those big categories, as you mentioned there, Jessie, is tax.
Yes, that's right.
And then in the case of, like I was sort of alluding to there with the dash dot model, is that exactly that. You could be, Jake and I are a great example. So, where we live is not where we purchased our investment property. We're not rent vesting, but we are good candidates for it because we are investing in an area that we would otherwise have had absolutely no idea about. So being able to get your teams working together, like your brokers and your investment partners, to assist you on that rent vesting journey is going to be critical, because the one thing you will know is where you actually want to live. Hopefully you do know that. And then you can kind of work backwards from there and be able to engage with the broker and work out, okay, well, if we are going to be purchasing other properties elsewhere, what does that look like? Now, something probably to mention just off the back of that, and going back to the first home buyer schemes, is that if somebody is in a rent vesting situation, so they haven't bought anything at all yet, but they're going to, and they purchase an investment property, what happens with the first home buyer grant or scheme at that juncture?
Yes, unfortunately, the disadvantage for the rent vesting is you might lose your first home buyer benefit, because buying an investment properties, even as your first home, you still need to pay for the stamp duty. But then when you going back and now try to looking at buying your first home for you to live in, one of the questions, for example, the government gonna ask you as always is, are you first home buyer? Have you owned properties in the previous time? Now you have to answer this question as no. So you might missing out some of the benefit as a first home buyer. So unfortunately, that's the things might happen. But if that properties rent vesting give you a good increasing or good capital growth for the properties, then you're making that money back.
So that's the sort of the pros and the cons. It's like you may not have that first time buyer advantage in terms of getting those stamp duty costs reduced or covered. You're able to purchase an investment property that's going to be a high, hopefully fast and high growth investment, so that really those costs associated with that property don't necessarily matter or impact your strategy that greatly.
That's right. Yes, that's right.
Excellent. And what happens, Jessie, if you're purchasing a property as a first home buyer, but you are doing that in a partnership with someone? It could be, in my case, it was my first home that I purchased was with my brother. So that was a situation in itself. And then obviously later down the track, Jake and I bought our principal place of residence together, so I no longer qualified for that first home buyer's grant. But can you talk us through the situation in terms of who you're actually buying with and how that impacts the first home buyer's grant?
Okay, so purchasing the properties together with your family members, like your siblings or parents, that's okay. But I generally will say to my clients, everyone has a different life path. So if you buy a property together with your brother, in the future, when you meet with someone, you want to buy that property together with your partner, a lot of lender will treating on that liability you joined with your brother. They will treating that as a one big loan under your name. Just because you bought together with your brother, if something happened, your brother lost his job, and you still need to be affordable to making the entire repayments. So potentially that going to be impact your borrowing capacities of purchasing a new property with your partner. So for buying properties together with a family, good thing is that will help you maybe to get into the market a little bit quicker, because then you can come up with part of the deposit, and your siblings or your brothers can come up with part of the deposit, and your borrowing capacity can be combined. But disadvantage, just as I said, is different person has a different life path. In the future, if your brother decides meet with someone and they want to buy the property together, he might also want to sell the property coming up with more deposit. So it might impact your plan as well. A lot of lenders now coming up with the policy like the property shares to making the loan a little bit simpler, especially you purchasing the property with siblings or family members. So you basically looking after one loan yourself and your brother gonna be looking after, or your siblings gonna be looking after another. But again, in the future, one of your situation changes, that will be impactful for the entire plans. Ideally, if you be able to buy the property just yourself by using the government benefit, let's say the first home buyer benefit, first home guarantee scheme, they're probably going to be making the plan much easier. Regardless, in the future, you want to sell the properties or you want to buy another property together with someone else, that will be much easier without impacting another person in your family.
When you talk about shares there or property shares there, Jessie, are you talking about like a tenants in common situation? So you're both kind of in that situation, be tenants in common. So you're responsible for the repayments on your individualized shares, whatever that split might look like?
Yes, that's right. So give you a real example. So for example, if I purchasing the property together with my partner and the loan account will having both of our name on it. So I can say access the account and my partner can access the account as well. So I can make the extra repayments into the loan and my partner can take it out. If you're buying the property together with a sibling, obviously when you try to make the extra repayments or you have an offset account linked with the loan, you probably don't want your siblings to access the money in there or access the extra repayments in there. So property shares making the loan very, very separate. So you can have a loan just under your name. You can have an offset account just under your name. And then your sibling can have a loan just under their name. And they can't access your account. You can't access their account. Just making the financials more separate to making the repayments or plans a little bit easier.
Right. So it's very individualized. Obviously comes down to the relationship that you have with your siblings. And if it is noting that, I think that was some great life advice there, that
Yes.
is, everybody is on their own path. And while something might suit you at a certain point in your life, it may not suit you again in a few years' time. So choosing very carefully who you want to pave that path with is very important in that beginning phase. And maybe if you're not sure, or maybe if you're you are single and you're not, the last thing you're thinking about is a partner, and you think, well, why should I let that journey stop my property journey? And, my brother is here ready to purchase something with me so we can both get a start on things. There's other ways that you can still equally protect yourselves, protect one another by having those separate finances sort of set up and established through the property shares method. But just having the awareness on all of these different options and the pros and cons to doing things a certain way. Or do you just wait a little bit longer and save a little bit more money and do it by yourself, and then have kind of no strings attached except for the strings you have attached with your lender? But that's it.
Yeah, that's right. That's right. And also on top of that, I think another disadvantage buying together with a family member. If both of you are first home buyers, that's great. Like the first property you're purchasing together, don't need to pay for the stamp duty, and both of you are going to be eligible for the first home buyer benefit. But then after that, both of you also losing that first home buyer benefit as well when you decide to move into another properties or buy another properties for yourself to live in.
Does that mean that if you're both obviously eligible for the first home buyers scheme at that stage, so that's good, but then you both lose it for your next purchase, which is also fair. Does that mean you get double the amount, like the stamp duty twice off how does that actually work out if you go in with a sibling or something in the first instance?
The lender's still looking at one properties. So for example, if you and your brother buy properties living together as your first home, of course, both of you had a benefit of living in your first home. So when you resell the property and when you try to purchase another property just under your name, unfortunately, in that situations, you already had the benefit of your first home, which is together with your brother. In that situations, then you have to pay for the stamp duty. So there's no more benefit as a first home buyer.
Yes. And then in terms of how that contributes to the reductions in that initial property, is that just that first grant amount, or is it like double the amount?
So it's still going to be the single amount. So for example, if you and your sibling purchasing a property together for $500,000, you're still getting a concession of $9,000 of the stamp duty concession, regardless how many people is eligible for the first home buyer in that transaction.
Got it. And if so, say you both purchase the property together, but only one of you is planning to live there, what does that mean?
If one of you are going to be planning to live in there, that is okay, because so a lot of the state, they actually allowed one of the applicant to live in the property for minimum time to be able to claim in the first home buyer benefit. So which means in that situation, for example, if I purchase together with my brother and I live in the properties for 12 months in ACT, both myself and brother still be able to claim in that property as a first home buyer property and don't need to pay for the stamp duty.
Right. Okay. That's great, Jessie. I think that all makes a lot of sense. And I hope that what this episode has done is given you some more ideas on what's actually available within the current schemes that are in the market at the moment and what your situation might look like leading up to the new release of the Help to Buy scheme and things like that can be available to you, whether you're a first home buyer, a rent investor, or purely an investor. In any of those situations, we know that speaking with your mortgage broker is one of the very first parts of the process you should begin with as soon as you can. And even if that means that you're not ready right away, that doesn't matter. Your broker, like Jessie, are going to be able to guide you through that process and give you more information on when you might actually be ready.
That's awesome. Thank you.
So for our listeners, I'm going to give the mic to Jessie to give us a bit of a wrap up on herself, on her team, on Loan Market, and how you might look to engage with them in the future.
Thank you, Kitty. So as a Loan Market, we are local business in Canberra. So we're known as Loan Market Canberra. So we have more than 7 brokers in our team. We have the people can help you with the home loan, residential loans. We also have the people to helping you with the assets finance, such as car loans or equipment finance. We have roughly about 20 people in our team, including onshore and offshore people. We're doing the heavy lifting between yourself and the bank and helping you to hold your hands all the way through until you find the property to purchase or until you settle on your refinancing. A lot of things I find out we do more than the other brokers is we're contacting our clients and build up the relationship with our clients even after settlements. I know sometimes when I'm speaking to some of the clients from the outside of the business and they said my broker or my banker never contacted me in the last 5 years. We contact you very, very regularly after settlement as well, especially on today's market. I think it's really important for us to make sure your rate is competitive on the market and make sure when we know the good interest rates coming up, we will notify you and you'll be able to get in that interest rates from your current lender as well. So that's the things we are doing. When you're making the purchase, we will hold your hands. We will talking to your solicitors, talking to your real estate agents to making the transactions as smooth as we can to make sure that you don't feel nervous during the journey and it's as smooth transactions as possible.
I can definitely vouch for Jessie and her team. As I said, Jake and I have used them personally on a couple of transactions, and in my other life, when I had my business, I worked directly with Loan Market and got to see a lot behind the curtain, and I can definitely confirm their systems and processes, as Jessie has outlined, are very smooth and regular, and they empower their teams and their brokers to be able to deliver the best possible service to their clients. So if you're looking for a safe place to start in the broking space, then don't hesitate to reach out to Jessie and the team at Loan Market. I will include a link to their page as I post this podcast. So if you have a look on my Instagram, you'll find exactly where to find them. But for now, I want to thank you, Jessie, for being on the podcast.
Thank you, Katie. Thank you for having me.
We will more than likely chat with Jessie again in the future to pick her brain on all the things we need to know about investing. But for now, I hope you enjoyed the episode and we'll catch you soon on another one of The Wing.